Welcome. You are listening to Purpose-Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casino, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Mo Bina.
Welcome to Purpose-Driven Wealth. I'm your host, Mo Bina. Today on the show, we have Dana Samuelson. Dana is the founder and president of American Gold Exchange, a leading national precious metals and rare coin company specializing in dealer-to-dealer trading and direct-to-consumer sales. He's also recognized as an authority in the precious metals industry and has been interviewed by major media outlets, including Forbes, MarketWatch, and Fox Business. Dana, welcome to the show.
Thank you, Mo. It's great to be here with you.
Yeah, thank you for coming on. Why don't we start off by you kind of talking more or a little bit about your background and how you became involved in the precious metals industry?
Well, it's a little curious. I got out of college in 1980 with a German degree. And like almost any graduate that got out of college in 2009, I was completely unhireable. We were going through the last major inflationary bout that we had gone through. The economy was not in a good position. Interest rates were 17, 18%. But my brother had been in the coin business for about 5 years, and he was working with a company in Houston, Texas that was handling a lot of bulk silver because the silver price had gone from about $3 an ounce to $50 an ounce, and people were selling silver they'd had for generations like crazy. And the company that he worked for needed someone to work in their vault that they could trust to back up the guy that was handling most of the material. So I was hired because I could be trusted. And it was literally, if it was a restaurant, I literally started at the kitchen sink. So I did that for 2 years. And then I got a lucky break. I ended up getting a job as a vintage coin appraiser trainee with Jim Blanchard in New Orleans. And Jim Blanchard is the man who is most responsible for the private re-legalization of gold ownership in 1974. When the U.S. went off the gold standard in 1971, and we quit backing the amount of dollars we had printed by ounces of gold in Fort Knox, Jim knew that that would be a situation where the dollar would lose purchasing power. So he lobbied to have gold ownership, which was outlawed in 1933, re-legalized. And that happened in 1974. And after he got it done, people asked, okay, well, where do we buy gold? And he said, well, I'll sell it to you. And then on the back of that inflationary cycle in the 70s, gold and silver prices took off from $40 an ounce in gold all the way to 800. By 1980, he had the largest mail order coin company in the business. So I spent my formative years working for Jim as a grader of vintage coins and a trader, a buyer of metal from the industry, and I became a senior trader and good friends with him. And that was my lucky break. I got to know everybody in the business working for Jim. And I finally had enough courage to start my own business, American Gold Exchange, in 1998. That was 25 years ago. So we're a small boutique national precious metals company specializing in modern bullion, gold and silver coins, and vintage U.S. gold coins.
Oh, great.
I'm a nerd, basically. That's really what I am.
Great. We love having nerds on this show because they really give us all the great insights and all the great details. So,
well, I am one.
So, Dana, since 2010, central banks have been net buyers of gold on an annual basis, especially when you look at countries like Russia and China, Turkey and India. And in 2022, just last year, central banks bought a record 1,100 tons of gold worth approximately $70 billion. Why are central banks accelerating their purchases of gold?
Well, that's a great question. If you go back to the 70s, central banks were net buyers of gold then, when we were in an inflationary period and the gold price was rising. And it was actually, gold was fixed in price from 1850 to the 1930s, and that was refixed in price from 1944 all the way to 1971. When we went off the gold standard in 1971, the price became free floating in the market for the first time at $41 an ounce. And as I said earlier, it went all the way to 800 in 1980. So during that inflationary cycle, central banks were net buyers of gold. Between about 1983 and 2005, the gold price channeled between $300 and $500 US. It barely got over 500 or barely under 500 during that entire 30-year period. And economies of the world were stable. Debt was rising, but not materially. It was only after the US was in the Iraq war, the Afghanistan war, and we went to deficit spending, and then the housing bubble burst and the great financial crisis came, that the gold prices really took off from about $700 an ounce to $1,900. And following the debt explosion that crisis led to, QE1, QE2, QE3, central banks started buying gold again. During that whole period from 83 to 2005, 2006, they were net sellers of gold. They didn't think it was necessary to have. But they changed their course again following the debt explosion. And they have been net buyers of gold since then, especially in the East, China, India, she said Russia. And I believe that they are net buyers of gold because gold is the most stable international currency that there is. It has no counterparty risk. And in an environment where every country is trying to devalue their currency so they can export more and make more sales, central bankers understand that they need to have something to counterbalance the loss of purchasing power of fiat currency. And more importantly, if they're owning a lot of bonds that other current countries issue, like US treasuries, and there's a chance of those being defaulted on, they have an asset that is a counterbalance to those liabilities that some of these other trading vehicles, paper vehicles have. I'm not saying the US is going to default on its treasuries, but it's a way for central banks to make sure that their exposure to other countries' financial issues are mitigated. Right? And the public should treat their own finances the same way central bankers are. Central bankers are very conservative, and when they start buying gold, that's really a sign that, hey, something's up. And the switch happened following the great financial crisis in 2010. You're exactly right. It got milder in 2017, 18, 19, and it ramped up again following the COVID economic closures and the renewed explosion of debt around the world. You know, today global debt is as high as it's ever been at about 260% of GDP across the board, I believe, or $260 trillion. Sorry, 260 trillion. It was about 150 trillion, I think, at the end of the great financial crisis. So debt just keeps growing and growing. And this is a way for central banks to mitigate their risk.
Yeah, and the other thing that's going on and that we're seeing more and more of is the increasing number of countries that are reducing their reliance on the US dollar as a medium of exchange or as a reserve currency. And, you know, this is now being called this de-dollarization, you know, movement that just seems to be getting more and more steam. Literally by the week, you'll hear about another country that's trying to move away from the dollar, or maybe it wants to move towards some other currency in order to to purchase, let's say, whether it be oil or some other commodity. It seems like all of this is really accelerating at an interesting time right now.
Right. Well, it is. It is. And there's a couple of major factors that have spurred this on. Number one is Russia's coming up. It's becoming more, you know, Xi Jinping has now become the president of China for his third term, and he solidified his power, right? So now he's stepping forward a bit more. China has been working in Africa and the Belt Road Initiative to create infrastructure projects for years. So they're playing the long game, right? Where most countries, especially the US, will play the short game. We can't even know where we're going to be able to pay our bills in 30 days because of the debt ceiling limit that's coming up. So you've got that. The second major impetus was, and more importantly, was the Ukrainian war, where Russia invaded the Ukraine, and we sanctioned Russia by taking them off the SWIFT banking system, and we weaponized the dollar. And having world reserve currency status, it enables us to be insulated from currency shocks. And, we're going to have commodity shocks as prices go up and down, but we're insulated through currency shocks because everything's priced in dollars. Every other country in the world gets both of those fluctuations. So you can have your currency lose value and you can have commodity prices up. So that's why inflation and other, like in the Eurozone, is higher than it is here, because the dollar was exceptionally strong last year. So this de-dollarization move is to help get, number one, countries from being politically punished for policies that are disagreeable to the United States, so they can insulate themselves from that potential situation, and to help insulate them from some of the currency shocks that they go through when we go through a period like last year where the dollar was exceptionally strong for about 6 months because of a higher interest rate differential here, where money from around the world was looking for safe haven. It found it here, and it took the dollar from up 20% in 1 year, which is it's a moonshot move in the currency. Now that's come back down to a degree, but it's more about the weaponization of the dollar and not wanting to be caught on the wrong side politically of an issue. So you have countries like Brazil are doing direct trade with Russia now for the first time ever in yuan. You have Saudi Arabia putting massive investments into Chinese, I meant China, into Chinese petrochemical facilities, right? So they can sell more oil into China and get more returns out of it. So you're seeing a move away from dollar trading into currency to currency trading among peers, India and China, Brazil and China, Russia and China, and Russia in particular. They're in trouble because they're being sanctioned by the US. So the thing about the de-dollarization movement is the dollar is so embedded, and dollar trading, pricing, clearing is so embedded into the international financial system. It's not something that's going to be ending the dollar's hegemony overnight, but it'll be a slow increasing water flow from a trickle to a stream to a rush at some point in time. It may take a few years or longer for this really to materially affect people here in the United States, but I think the dollar was about 75% of world trade in 2000, and today it's about 48% of world trade in 2023. So we're seeing the dollar's share of international trade diminish naturally over time, and now it's accelerating. And this really, could be a real problem for the US in the future, because if other countries don't want to buy our treasuries because our financial house is out of balance, if they don't trust the dollar because our finances are not right, they have an alternative place to go, which they really don't now. If that becomes a possibility, which China is moving towards with the yuan, we will be subject to those currency fluctuations and commodity fluctuations that I described most other countries have been subject to since 1944, when the dollar was made the world's reserve currency. So it's a big issue, but it'll take time for it really to flow through and hit the markets. What the US does have that no other country has except for the Eurozone is a gigantic credit market, our bond market, transparency in our markets, and trust in the transparency and the trading ability to both buy and sell. China has currency controls right now on how many yuan can go in and out of the country, and they can never have the world's reserve currency until that money can flow freely both in and out of the country. And they also have a command and control economy, so there's no transparency really for markets and market pricing, price discovery. So it'll be a while before something can truly replace the dollar on the level that the dollar is the world's international reserve currency, but they're working towards it. And this will be a big change when that challenging of the dollar is really actually able to happen.
Yeah, I think one of the things that really caught my attention with this de-dollarization effort was when I heard that Saudi Arabia was going to be moving away from selling its oil. And for people that know, I mean, this is going back many decades, when the US basically went to Saudi Arabia and said, we'll protect you as long as you sell your oil and as long as you sell your oil on the world market in dollars. And so Saudi Arabia has been under the protection, and I put it in quotes, right, under the protection of the US government, since then. And so for Saudi Arabia to want to break away from that, I think that really speaks volumes. And although it was covered in the news, it wasn't the ramifications of that, I don't think were really, I guess, really covered within the mainstream press. Because I thought that was really significant and really profound change, and then it just seems like now you just hear about so many other countries that are just kind of tagging along and really going in that direction too.
It is amazing how a slow trickle suddenly became a stream in that regard.
Yeah.
And that Saudi Arabia, MBS, the de facto king of Saudi Arabia, he's been ostracized by our president. And again, we've politicized our trading with our trading partners to the point where they want to go seek other trading partners and how they do business in a material way. And that is a sea change that is gigantic. And you're right, the media here gave it short shrift, a headline. And it is a major, major change of policy that will impact us in the long run, not so much in the short run, but it'll continue to build over time.
Yeah. And what are your thoughts in terms of how far do you think this de-dollarization effort will go? And it seems like a lot of this de-dollarization effort has been moved and shifted kind of to the yuan. But then when you also look at the debt of China, and you talked about some of the capital controls and the lack of transparency, I mean, ultimately, won't some of these countries then start to come to the conclusion that the yuan is just another, that's something that they're going to have to move away from again into something else? I mean, what are your kind of thoughts more longer term about how this may play out?
Well, there is no good alternative. There really isn't. The euro is actually the most significant challenger to the dollar hegemony right now. But the way every country runs their finances with fiat money that's not backed by anything sound, and there's no control on the debt in particular. That's why there's really no good alternative to the dollar. So it's a question of, okay, do we have an alternative that's close or something that's viable that at least gives us a backdoor to protect ourselves in the event that something happens with our primary currency, which is the dollar, which goes back to why, central banks buying gold, right? They're increasing their gold position. This kind of falls into the same argument. Why are they doing this? Well, it wasn't because of the dollar becoming weaponized following the Ukrainian war, but it certainly makes it seem like a smarter move now that that's another factor along with all the growth of global debt.
What do you eventually think that this will do for the demand of gold? I mean, do you foresee, I mean, it seems like it more than likely is the case that central banks will continue to buy gold into the future, perhaps even increase those purchases, right? I mean, how do you kind of see that playing out in terms of the effect on gold demand and also the gold price?
Well, gold is the currency of last resort. It is the oldest, most trusted form of value for trading. It goes back 2,500 years to ancient times. It has no counterparty risk, which is a major, major reason for its desirability. And it's instantly liquid, right? So these are the major reasons why central banks would want to own gold. Now we're going to have digital currencies. That's coming. So they will replace some of the paper money that we have. And that's an experiment that we have to see how it plays out. And I'm not really the best person to discuss central bank digital currencies with. They have, we all use credit cards. It'll be an extension of that. the way we do business, only be able to be tied to our bank account as opposed to tied to a credit company that issues us credit. But the problem with central bank digital currencies is they can put money in your account, but maybe they can take it back out. And our own personal accounts could be weaponized, just like we've weaponized the dollar against Russia. From 1795 to 1995, the US accumulated $5 trillion in debt. And from 1995 to 2023, 28 years later, we're at $31 trillion in debt. Our debt has gone up sixfold. And if you look at this debt increase on a chart, it's spiking. And this is a trading pattern. If you look at any stock, any commodity that trades in a pattern like this, it means it's going, at some point in time, it can't continue. And this is why demand for gold is at record highs for central banks. And it's really, and the price is now near an all-time high as well, but it's really not so much that gold is that much more valuable. It still buys the same amount of goods and services that it bought 40 years ago, 80 years ago, 100 years ago. It's that the value of the purchasing power of the currencies that are buying it are that much less. And that's really what your listeners should try and appreciate, is that the purchasing power of our money is losing value at a record pace right now. When inflation's 1-2%, and it was that way for 6 or 8 years, you don't really feel it. But when inflation jumps to 6, 8, 9%, we feel it. A carton of eggs was $1.40 3 years ago, and that was $1.50. Now it's $4. I mean, you really feel that at the grocery store. And that's why demand for gold among people that understand this, not only for central bankers, but individually, has ramped up a bit. Since COVID and our debt explosion, my business on average is 4 times what it was the 3 or 4 years previous to that. And people don't trust, they're less and less, they're trusting the government's ability to manage their finances correctly. So demand for gold is going to continue to remain strong.
I see. What are the different ways for investors to have exposure to precious metals?
Well, I'm in the physical precious metals business. So I buy and sell physical gold in various forms made by refineries or sovereign mints like the US Mint, the Royal Canadian Mint, South African Mint, Austrian Mint, British Royal Mint. So you can buy and sell physical gold or physical silver same way. These transactions have a bit of friction because you're dealing in a manufactured product that has to be perfect. It has to have the right specifications for size, weight, and purity. So they're not efficient transactions. There's a buy-sell spread that's much wider on physical precious metals than you would expect in a stock or a bond when you're buying and selling immediately. On gold, it's 3 or 4%. On silver, it's $1 to $3 an ounce. And this is meaningful if you want to, trade. But if you want to own gold physically, it's really the only way you can do it. Now, you can also buy and sell exchange traded funds, which are a paper representation of the gold price. And you can do it at the touch of a button on your computer with all the major trading houses. There's GLD for gold is an exchange traded fund, SLV for silver. There's also exchange traded funds out of Canada under the Sprott, SPROTT house, which is a major financial house. And I would look into their gold and silver ETFs as well. So that's a way you can harness the price movement of gold and silver on paper if you want to be a trader and you want to do it efficiently. You can also buy or sell mining stocks, which are the companies that actually pull gold out of the ground. And there you're betting on the quality of the deposits, the ease of extracting those gold and silver deposits from the ground, what their purity is, how effective the company that manages that business is, and what the price is. If you can get gold out of the ground at $1,500 an ounce and the price is $1,750, you're making $250 an ounce. And then if the price jumps to $2,000 an ounce like it is today, well, your profits have doubled, right? So technically your stock could double in price too. So the mining companies have leverage. The mining stocks have leverage to the gold and silver prices, but these tend to be volatile. So it's not something I would call a buy and hold investment. If you're going to be buying and selling mining stock shares, you have to be actively paying attention to them because they can be kind of feast or famine. So physical gold and silver is a way to take some of your hard-earned money and get it out of the banking system, out of dollars, and save it, your assets, as a savings account. Only instead of dollars, you have gold and silver. And it's really a great way to go if you want to put some money aside for savings that you don't think you're going to need to touch. That's really where physical gold and silver are best used for most people, as a savings account. They tend to be decent investments over time, but you shouldn't really look at your core gold and silver holdings as an investment, more as a way to have an insurance policy for the rest of your money. If we go back 20 years, gold has averaged about a 7% gain every year for the last 20 years, although it's lumpy. It could be 5% one year, 3% the next, 15% the next, and then down 10% the next year after that. So it's lumpy. But over 20 years, gold has averaged about 7-8% a year, about the same as real estate. And it's quite simple. They keep printing more and more money, and there's only so much gold and silver to go around, like there's only so many houses or lots of land to go around. So the buyer's pool keeps growing where the available supply is pretty fixed. That's a good way to look at the gold and silver prices over time as well.
Yeah, and it's kind of interesting how you kind of mentioned about an insurance policy. Well, I know we didn't really get into this in the beginning, but there have been a number of bank failures, right, that have been going on. And so when you think about FDIC, right, Federal Deposit Insurance, and what a lot of people probably don't know is that there's not nearly enough money, within the FDIC to cover if there was a larger scale or a series of bank failures that would take place, again, especially among the larger banks. There's not nearly enough money, to recapitalize and to make people whole. And so when you think about, well, instead of just relying on the FDIC as insurance, right, why not just acquire some precious metals, right? And that basically would be insurance, not one that you have to depend on someone else for, but basically kind of in a form of like a self-insurance, right? And having, in a way, kind of diversifying and having insurance against all your dollar-denominated assets, if you want to think about it like that.
Exactly. That's exactly right. So when SVB Bank failed, our sales skyrocketed overnight. We were in a quieter phase, and volume of purchasing went up 4 or 5 times, and it lasted for 3-4 weeks. What most people probably don't realize is that the amount of cash that came out of the banking system, money that came out of the banking system for 2 weeks following the SVB bank failure, was enormous. But it abated once the Fed stepped in and said, hey, we're going to insure everybody that was deposited at SVB Bank, even the larger accounts. Because if they hadn't done that, the panic would have ensued and stayed higher than it was. But if that amount of money that had come out in those first 2 weeks had stayed at that rate for the next 2 or 3 weeks, what you discussed about the lack of capitalization would have been material, and it could have really affected our banking system dramatically. The fact that the public regained confidence and stopped pulling their money out, and ironically, they put it into a lot of U.S. treasuries, right? Because the yields on the treasuries fell sharply. The 10 and the 2-year treasury, all the treasuries lost at least 0.5 point as all that money came out of the banks and went into treasuries. It's another way of having insurance for your money, but now we're looking at a debt ceiling negotiating, and if I don't think we're going to default on our debt, but if we ever did, oh my God, the problem we would have with our treasury market would be gigantic.
Yeah. Going back to precious metals, so for what types of recommendations do you make for people that are interested in having physical precious metals? Because there's so many options out there, and you kind of mentioned some of them already. What do you suggest that people do?
Well, first of all, any financial planner will tell you should have 5 to 10% of your assets in gold and silver as just a hedge. The World Gold Council says 6 to 8% is really the sweet spot where you have enough to have that hedge or insurance policy without having lost opportunity in other investment sectors. Number one. Number two, in the physical marketplace, I really like the sovereign minted 1 ounce gold coins that the US Mint makes, where they call them 1 ounce gold eagles. The Royal Canadian Mint makes Canadian 1 ounce gold maple leafs. The Austrian Mint makes 1 ounce gold philharmonics. These are all guaranteed by the governments that make them. They're guaranteed for size, weight, and purity. But more importantly, we're having a modest but growing problem with Chinese counterfeit gold and silver coins and bars. Now, there are also refineries that make bars. In Switzerland, there's a couple major refineries. There's one up in Canada that make privately minted 1 ounce gold bars, same in silver, 10, 100-ounce bars. It's much easier for the Chinese to counterfeit a gold bar than it is for them to counterfeit a sovereign minted coin that's struck with dies like the coin you have in your pocket. So I don't think that the sovereign minted coins are going to have the kind of a counterfeiting issue or sellability issue in the future that some of these reputable manufactured bars may have, as we see more and more of these bogus Chinese bars come into the marketplace. It's just easier to make a design that's plain on a bar for the Chinese than it is to make a gold and silver coin look good. Now, this is a small problem, but it's out there. And if you think you're getting a deal that's too good to be had, it is. Trust me. So that's why it's important that if you want to buy physical gold and silver, you stick with the modern minted, sovereign minted gold and silver coins, and you do business with a reputable, long-standing dealer in the community. And you can check dealers out through reviews, their longevity, what associations they belong to. The Chinese are also counterfeiting websites, believe it or not,
Wow.
to clone some dealers' websites. So you really have to drill down a little bit and know who you're dealing with. It's not a problem for the masses, but it is out there. And if you don't really do your due diligence at a minimum degree, you could be fooled. So we stick with the sovereign minted coins that have design elements built into them that are to stop the counterfeiters' ability to replicate them. So this is a U.S. silver eagle, a 1 ounce silver eagle the U.S. Mint makes. They changed the design for the first time in 2021 to update the picture on the coin for this very reason. They've also taken a notch out of the edge of the coin where we call these denticles, the little edges around the coin. Now, it's not hard to make one of those notches disappear when you make these things, but it's impossible to make them all disappear in the same place. It's really hard. So every year, one of these gold and silver eagles has one of those denticles missing at a certain place in the coin, and all that year's issue is made that way. The Royal Canadian Mint, when they make their maple leafs, they have this little tiny frosted, creamy looking maple leaf on the back that's really hard to replicate. So the mints around the world know that they're being counterfeited. So they're introducing design elements to minimize the replication of that. So this is how you should stick with mainstream items that are widely traded, competitively priced. And that's what I do. It's better for everybody. And there's a million items in gold and silver. You can get a gold or a silver, treasure bar, or a coin that looks like Superman if you want, but who cares about that for investment, right? So I stick with the mainstream items. I call it chocolate, vanilla, strawberry, US Mint, Canadian Mint, Austrian Mint. It's as simple as that.
Yeah. And there's also, another market, or I shouldn't say another market, but there's also other options out there, such as numismatic and kind of more rare coins. Like, do you ever recommend that people get involved in that, or to kind of stick to like you said, the vanilla chocolate and strawberry flavors.
Well, I'm a vintage U.S. gold and silver coin expert, and it's something I'm extremely familiar with. And there's a vibrant market in those classic historical coins that survive today from the 30s and earlier in gold. They have some, like mining stocks, they have some leverage to the gold price because they're limited in their supply. So when demand can be strong, the price appreciation can be faster than the underlying metal content on its own. And that can go two ways. But for people that want to have just a simple insurance policy, basic sovereign minted modern bullion coins are the best way to start. Now, once you have your core insurance policy created, if you want to dabble a little bit in something that's a bit more speculative, some of these vintage coins can offer a lot of value depending on where their premiums are and how much demand there is in the marketplace at the point in time that you're interested in them. And we also deal in really rare coins. I mean, the U.S. Mint's been making silver coins since 1793 and gold coins since 1795. And some of these individual coins can trade in the marketplace for $5,000, $10,000 a piece, $100,000 a piece, $1 million a piece, depending on how rare they are. That's a different market. It's a supply and demand driven market, not a metal driven market. So there you really need a true nerd like me to help you if you want to play in that market. So, but it's like art, rare art. There are really rare coins out there that have lives of their own that go back 100, 150 years. We know where some of them have been for that entire period, who's owned them, and auction records too. So you can check out auction houses to see, where some of these coins are trading at. But that's a completely different market, and it depends on what your level of participation you want to be in.
Yeah, I see. And so for investors who have physical holdings, what are some best ways in order to store their metals? And is insurance something that people need to also kind of be mindful of or think about as well too?
Well, gold is very compact. You can hold a lot of value in a small space. 100 ounces of gold today is about the size of a paperback novel, and it's about $200,000 in value. It weighs about 7 or 8 pounds. You can carry that much in your pocket and no one would know that you have it. So it's very easy to transport and store and give to somebody if you want to. With the gold to silver ratio today at about 80-1, where it takes 80 parts of silver to equal $1 value of an ounce of gold, silver takes up a lot more room. So you have to keep this in mind when you're considering both gold and silver from a storage point, because it takes a lot more room to store silver than it does gold, equitable dollar amount of value. We used to recommend that you put gold and silver in bank safe deposit boxes, but we don't do that anymore, because what if there's a banking holiday and you can't get into your safe deposit box? Now, there are private storage facilities around the country. They're few and far between, but there are places where there are private vaults where you can store your metal. There's a couple of professionally run facilities that we recommend. One is in Las Vegas on the grounds of the McCarran Airport, inside security. One is in Delaware. If you have a lot of physical silver, these are good options, so you don't have to worry about storing silver. Gold you can store at home if you'd like to, or try one of these private vaults. It is compact and it's easy to hide. So it just depends what your comfort level is. The rule of thumb is you want to have access to it and be able to sleep at night. And where it's stored, don't always offer both of those at the same time, right? So it's just what are you comfortable with? I can recommend storage facilities to your listeners if they were interested. Insurance is a niche market for our market. If you go to your traditional insurance companies, the big names out there, they're not going to give you competitive rates where you can get from some of these niche market players who are more used to insuring physical precious metals. But again, it's a little bit cost prohibitive if the metal's not somewhere that they like it to be, where it's not moving around. At these storage facilities, the professionally run storage facilities, your storage fee, which is about a 0.5 percentage point of value a year, is insured value. So that insurance comes with that if you want to be able to do that. So it's a little bit, you really got to think about it. But gold is pretty compact. You can put it in your house somewhere most people would never find it. Silver, it could be a little bit more problematic.
Yeah, and I guess, like you said, those kind of professionally run facilities have the added benefit of not just storage, but also the insurance that comes along with it as well, too.
Right. So we have clients that store there where we do a transaction with them. We just ship it to their account at one of these places and it gets deposited there. And then the client's got a receipt from the storage facility. If you want to go look at your metal, you can do so by appointment. If you want to sell it, you can sell it just as easily in a phone call and not even have to touch it shipping wise.
Oh, really? At some of these facilities, so they'll actually then ship it directly to a dealer like yourself, I guess, and it can be sold, and then so they could. Wow, that's kind of interesting. I never thought of it that way. So they could actually purchase the precious metal, have it shipped, have it stored in this facility, and then at the same time, if they ever needed to sell or liquidate for whatever reason, it could be sent back to someone like you, then sold, and they can get their money.
Right. Or, we have accounts at these storage facilities ourselves too. Or we would do what we call a shelf swap, where they simply take the metal off of your shelf and put it onto ours, and ownership is transferred and we pay for the metal.
And I assume that the storage facilities, they're routinely audited as well too, to make sure that the metals are actually there as people are being told.
Yes. Yes.
And Dana, can you kind of walk through and explain how you work with and how you can help investors that are interested in acquiring precious metals?
Well, my company is a national mail order company. We're a small boutique. I have got 4 personally trained account managers who most of them have been with me for almost 20 years. So we're consultative in nature. If you're interested in purchasing physical precious metals or vintage coins, we'll go through with you on an individual basis why you want to buy metal, what your purpose is, what your risk reward factor is, what your time frame is, and then how much you might want to invest either initially or over a longer period of time, and try and help you find the best products that will suit what your particular needs are. We'll also look at how gold is priced relative to silver to see what might be a better value for you at the time. We also deal a little bit in platinum and palladium, which are the other 2 precious metals. Silver tends to be more volatile in price than gold. So if on a sine wave, if gold is moving at a moderate basis, silver tends to move at a wider basis along those same trend lines. So there's times when silver is just cheaper and it looks like a better value. So if you already have a core position established and you want to add some more, and you don't know which metal to pick, we'll help you that way. So we truly want to help you understand the best products, what's the best pricing for you, how you're going to get the best value, ease of sellability in the future if something happens to us, and make sure that you are doing what the best you can for yourself. Our business model is mostly based on repeat business and referrals, and you don't get those if you don't take good care of people. And that's what our business model is, to try and really help people through a consultative, no pressure method.
Oh, great. And so how can people get in touch with you if they're interested?
Well, our website is really where most of our value can be found on the easily. It's www.amergold.com, Amergold. We have live transparent pricing. We only have on our website the main bread and butter products, or ice cream flavors, as I mentioned before, chocolate, vanilla, strawberry. And there's a lot of information where you can poke around and learn about the various mints that are available and how they're priced relative to each other. We also have some gold news on there and gold commentary that I put out discussing what's happening in the marketplace, like we've discussed about de-dollarization and market pricing. General email box is info, INFO, @amergold.com. If you want to start a conversation, that's the best way to start. Send an email, or you can call us on our 800 number, 800-613-9323. You can get started that way. We have a Facebook page, AmericanGoldExchange.com, and we have a LinkedIn presence. We're fairly weak on social media. I'm kind of old school. our website's really where most of the valuable information you're going to find is.
Okay, great. And we'll include links to all these resources that you just mentioned. We'll make sure that they're in the show notes for this episode as well.
Great.
Dana, thank you for coming on to the show today. You provided an amazing amount of value to the audience.
Well, thank you, Mo. Like I said, I'm a nerd. I've been doing this for 43 years. So I do my best we really, truly want to help people. When I started my own company, that's really what I wanted to do, was help people. My most valuable asset are my customers. And as long as I treat them well, I've been treated well in return, and it's a two-way street. And that's really the way I look at this. So thank you for having me. I really appreciate it. And I hope we've been able to help people understand this market a little bit better.
Oh, definitely. Thank you. You really shared some great insights, and I'm sure the listeners really appreciate it as well. Thank you again for coming on today, and thank you everyone else for tuning in. And until next time, have a great week.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.